There is no binary option here. The dollar is on its way out because it doesn't matter how much resources the US controls through its empire proxies. What matters is the gold convertibility of the dollar. The dollar is not an oil derivative. It is a gold derivative. It's
of assets may vary considerably. And I mean, I've seen now in the gold market and silver market, silver was over $100. Now it's below $80. I mean, it goes very quickly. And so your portfolio could be worse, say at month's end, February 28th, could be worth 100. And when you wake up on March 31st, it could be down to, I don't know, 80 or 70, or maybe it's up to 150.
The global monetary system may be approaching a profound turning point, where the future of currencies is determined not by geopolitical power or control of natural resources, but by the underlying trust that supports them. In times of financial instability, history repeatedly shows that currencies disconnected from real monetary anchors tend to weaken or collapse. As economic pressures mount and confidence in fiat systems fluctuates, attention increasingly turns toward the fundamental relationship between money, credit, and tangible stores of value. Rafi Farber argues that the value of the US dollar does not ultimately come from oil dominance or military influence, as the popular petrodollar narrative suggests. Instead, he believes the dollar historically derived its credibility from its link to gold, even though that formal convertibility ended decades ago. According to Faber, the idea that governments can enforce value in a currency simply through taxation or coercion is flawed. Hyperinflation, he notes, repeatedly occurs in countries where governments still demand taxes in their own currency and enforce its use, yet those currencies collapse anyway. For him, this demonstrates that force alone cannot sustain monetary value. What matters is a currency's perceived relationship to real money, historically represented by gold. Faber further contends that global attempts to replace the dollar with another national currency, whether led by China, Russia, or any other power, would face the same fundamental limitation. In his view, credit systems ultimately depend on trust rooted in real monetary value, not political authority. If confidence in the dollar erodes because its connection to gold disappears in practice, countries may increasingly turn directly to gold or other tangible assets for settlement. Such a shift, he suggests, would not immediately create a new dominant reserve currency but could instead trigger a long, gradual transition toward a more decentralized financial system where markets themselves determine the next form of global money. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying close attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
There is no binary option here. The dollar is on its way out because it doesn't matter how much resources the US controls through its empire proxies. What matters is the gold convertibility of the dollar. The dollar is not an oil derivative. It is a gold derivative. It still is a gold derivative. The entire concept of a petrodollar, it sounds convincing, but it's not true. And the reason is actually pretty simple. The argument that a fiat currency gets its value from force, that the paying of taxes in that fiat currency is what bestows value upon a fiat currency, and by extension, if America takes over all these other countries with oil like Venezuela, Iran, etc., and then controls those resources, then the dollar gets strengthened. That is an extension of the argument that force is what confers value upon a currency. But that's not true. Why isn't it true? What's the easiest proof against that theory? Hyperinflation itself. All hyperinflations happen in countries where the currency that's hyperinflating is backed up by force of violence, a threat to kill you if you do not pay taxes in that currency, and nevertheless, the currencies collapse anyway. The force does not confer value on a currency, only its convertibility back into money does. And so whatever way this war goes, whether America and Israel win or lose, however you want to define that, the dollar will not benefit either way. What matters is the gold value of the dollar, not the oil value of the dollar. The oil value of the dollar stems from its gold value. Everything stems from its gold value. That is inescapable. My contention is that whatever the outcome of this war, the dollar is going to die anyway. And just because the US would force countries to use the dollar to buy oil that it controls doesn't give the dollar itself any value. The gold value of the dollar is what gives the dollar value and the ability to purchase oil in the first place. Look at the countries that are hyperinflating. Both Venezuela and Iran are hyperinflating countries. They are both countries with destroyed currencies, and they both have huge amounts of oil. It doesn't make a difference. To argue that the dollar has value because it is backed by oil is cart before the horse logic. The truth is, it's a currency's gold value that gives a military its power, not military power that gives a currency its value. Hickman goes on to say that if America loses this war, then China will organize a new Bretton Woods system under its own auspices or teaming up with Russia that would create a new Bretton Woods system that would destroy the dollar. But that is impossible because you cannot create credit out of nothing. Credit draws its value from money itself, from gold. The way the US was able to convince countries to take its dollar is because it was trustworthy and it was backed by gold when it started to spread all over the world. That's what makes it a reserve currency. But if the dollar has no gold value, it doesn't matter how much oil the empire controls because it is the currency that allows that control to happen. It's the gold value of the currency that allows that control to actually work. And if the dollar is hyperinflating, then the only choice countries have is to abandon it and to use gold instead. There is no other alternative. The dollar is the premier credit vehicle of the world. Every other credit system is based on it. But if you want to get around the dollar, you'll have to use gold directly. And countries can do that. They would have to give up the ability to inflate their own currencies. That's true. But they can get around the dollar only with gold itself. And that is what is already happening. Here's an excerpt. Once you understand that, you understand there is no replacement for the dollar except for money itself, because the dollar is a derivative of money. It is not a derivative of oil. And so whether or not America wins the war, however you want to define that, what matters is the gold price of the dollar, whether the dollar can acquire any money at all. If it can't, America might have conquered the entire planet, and the dollar will collapse anyway, and then it will all disintegrate, and we will go back to square one using gold and silver as money. And whoever is able to do that honestly in a free market way without stealing, they will be the ones with the privilege of creating the next credit system. It's not going to be China. It's not going to be Russia. It's not going to be any government today. It's going to start from the free market, sprouting up from the bottom and moving higher. And that process will take many decades, at least. Remember, it took 1,000 years post-collapse of the Roman Empire to rebuild society as it once was in the Renaissance. This time, I don't think it will take 1,000 years, but it's not going to be an immediate transition into a new currency credit system run by China or Russia or any other regional or superpower today. We're going back to gold and silver. There is nothing any country can do about it. And once we do, we will be a decentralized human race again, and from there, the free market can sprout and thrive, and perhaps we can go back to a more sane planet and finally live in balance with our surroundings.
Asset prices can fluctuate dramatically in short periods, especially during times of geopolitical uncertainty and economic stress. Marc Faber explains that markets currently sit at relatively elevated levels, meaning valuations can swing sharply in either direction. A stock priced at $100 today could quickly move to $120 or fall to $60 depending on market sentiment and global developments. Similar volatility can be seen in precious metals, where silver recently dropped from above $100 to below $80 within a short time. Faber emphasizes that predicting the true fundamental value of assets is extremely difficult, particularly during wartime conditions when inflation often rises. This creates a complicated policy environment in which economic slowdown may require lower interest rates, but rising inflation could prevent central banks from easing monetary policy. Faber also argues that broader structural shifts in the global economy are contributing to today's tensions. He believes the rise of emerging powers, particularly the BRICS nations, is inevitable as economic leadership gradually shifts away from the United States. Historically, dominant powers often face rivalry when rising economies begin to challenge their influence, which can lead to geopolitical conflict. He points out that while the US once dominated manufacturing and technology in the mid-20th century, other nations such as Japan, South Korea, and eventually China eroded that dominance over time. Today, China has become the world's largest industrial producer. In this uncertain environment, Faber notes that markets can react unpredictably to geopolitical shocks. When volatility spikes and emotions dominate trading, his preferred strategy is often patience, waiting for markets to stabilize rather than rushing to buy assets, particularly highly valued technology-heavy indices like the S&P 500 or Nasdaq. Let's get back to the interview.
In America and also elsewhere is at a relatively high level, with few exceptions in emerging economies and so forth. So say a stock is at $100. It could be in a few days or in a few months at $120, and it could be at $60. You understand? The valuation assets may vary considerably. And I mean, I've seen now in the gold market and silver market, silver was over $100. Now it's below $80. I mean, it goes very quickly. And so your portfolio could be worse, say at month's end, February 28th, could be worth 100. And when you wake up on March 31st, it could be down to, I don't know, 80 or 70, or maybe it's up to 150. We don't know. But all I'm saying is the valuation of assets based on fundamentals is very difficult to calculate. And given the war situation, we may have a situation where during war times, in every wartime, around the war times, inflation picks up and prices go up. And that may happen this time, which would make it difficult for interest rates in the US to decline. And we may need lower interest rates because of the economic decline that will be caused by the war in the Middle East. So in theory, interest rates should go down, but maybe they won't go down because of rising inflation. Well, in my view, the rise of BRICS countries is inevitable. And of course, that, and I've written about this 10 years ago already, in the war cycle theory, it's very clearly demonstrated that if you have a superpower and then you have a rising power, and economically the rising power at some point may actually overtake the existing power, that this leads to tensions because the existing power doesn't want to lose its hegemony and its superiority, especially the US. If you look at the US in the 50s and 60s, they were way ahead of everybody else technologically, in innovation, and also in military power. Then in the 70s, gradually Japan and Taiwan and South Korea eroded American manufacturing, but slowly, because Japan wasn't a huge country. But then in the 80s, Japan became big in the capital market, so it became a factor attracting capital. And by 1989, at the peak of the market, Japan, with just a population of 120 million, they had a market cap of 50% of the world's stock market capitalization. It is now around 5%. But then China came up and other countries, and suddenly the US is no longer the industrial powerhouse it used to be relative to the rest of the world. So we have now China, that is a dominant industrial power. The largest industrial production in the world is in China and not in Europe and not in the United States. Yes, this is very interesting that they are being sold as much as they're being sold. That, I have to say, is a little bit a surprise to me. I didn't expect them to go up necessarily, but I thought they would go down less than equities. And what has happened, they go down actually significantly, and gold miners are very weak. They have been weak already for several days or weeks, but they are particularly weak in the last 2-3 days. Look, this is always a very good question when you're in a bull market and then you have the first downtrend or the first setback. Do you rush in and buy, or do you stay aside? I wrote in my report that the best course of action when something like this happens and you have a shock and assets move a lot, the volatility increases a lot, the best course of action is frequently to do nothing and to wait until the markets become again less emotional and more rational. In, let's say, hostilities are occasionally favorable for stock markets and occasionally they're not favorable. And I would like to define this. If you are in a bull market, hostilities offer a buying opportunity because the market sells off and then it goes up, like 1991 in the US, the Gulf War offered a buying opportunity. But on other occasions, the markets are very high, like now. The valuations are very high, and the hostilities may lead to a catalyst to push prices down, and they could go down substantially, particularly the indices like the S&P and the Nasdaq, which are loaded with technology stocks and the so-called Magnificent Seven share. So that I would avoid.
How financial markets are entering a period of heightened uncertainty shaped by geopolitical tensions, shifting economic power, and fragile asset valuations. War, rising inflation, and structural changes in the global economy could trigger sharp swings across stocks, commodities, and currencies, making it increasingly difficult to determine true fundamental value. As global influence gradually disperses and new economic blocs gain strength, markets may experience both sudden sell-offs and temporary rallies. In such an environment, patience and caution become essential, since volatility and emotional reactions can easily dominate short-term market behavior while longer-term economic transitions continue to unfold beneath the surface. How might rising geopolitical tensions and the shifting balance of global economic power influence the long-term stability of financial markets and the future role of major reserve currencies? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.